Hi everyone, hope you're all doing well. So just before the weekend, I wanted to make a really good video for you guys to watch. And I just wanted to talk about now that we're kind of entering back into a bull market. Well, we officially are back in a bull market. And crazy is to think it's a year ago since we were going through that horrible stock market crash. And obviously at that time, everything was negative. You could go on any website, any news outlet, any comment section, any forum. Everybody hated stocks. The stocks were going to bankrupt. And now to see, and I don't think many people would have believed it, that in a year's time we'd be back in a bull market. I thought, and we're also halfway really through 2023, I thought now would be a really good time to reflect on what has happened, the crash that happened, and also stocks that I sold, and if I was wrong to sell a couple of stocks as well. So hopefully this video will help you guys. It helps me to look at it and go, how can I be better as an investor? And hopefully you enjoy it and get something out of it. So let's get started. So first of all, back in a bull market, it's crazy to think that, we are in a bull market, and that pain we went through in 2022 was the first pain we've had for a while. We had, for me as an investor, I've been an investor now for 7 years, I think it is. I've been investing into stocks, and obviously for me, this was the first major crash that I've been through. And I mean major crashes, not just like 2018 where stocks dropped 20%, but it was for, about a year. Maybe the dip for 2020, obviously that was a stock market crash, but I mean, that stock market crashed rapidly and it was brutal at the time. Any of you guys that went through that 2020 stock market crash, you guys will have known what that was like. It was massive red day after massive red day. Like the S&P was down 4-5% every single day. And all of them stocks you held before 2020, you've seen those gains rapidly start going away. And that was quite a brutal time. But the thing is that it only lasted for like 2 or 3 months. And within 2 or 3 months, the stock market started doing a V-shaped recovery. And we were basically back to where we were within 2 or 3 months. So it was a brutal time, but you only had to stick through it for 2 or 3 months. 2022 was the first stock market where it was not as rapid as the 2020 dip. The 2020 dip was 4-5% on the S&P going down every single day for a while. Whereas the 2022 dip was kind of 1 or 2% kind of every single day, adding up for, kind of every couple of weeks it was down 2 or 3%. And even for some of the small caps, they actually started dipping in 2021. So you had basically a year, maybe a year and a half of stocks just dropping and dropping and dropping and dropping. And every time you had a little bit of hope, it gave it back. And it was quite a awful market to go through, where you were just sitting, month after month thinking, is this the month where we see a recovery? And it would go lower and lower and lower. And it was a really tough time. That was the most testing time as an investor I've been through. The S&P was down 20+%, was it 25%? The Nasdaq was down 30 something percent, 35% or whatever it is. Quite a tough period of time where you finally saw, and that was a change from where we were for the last few years, where stocks, it's been quite a nice market, and you've had stocks go up and up and up, where you were just buying things and everything was just getting dragged down. You could be buying fundamentally great companies and they were just getting dragged down. And even the big stocks, the big tech that hardly dips, even some of them were getting dragged down 30, 40, 50%. And it was the first kind of big bear market that we've had for a while. You got to remember, from January 2022 to about August 2022, I believe that was the worst stock market we've ever had. And that's something to say, that through that period of time, it was the worst stock market that we have ever had. And it was the first time to see your account getting really dragged down. I think some people have this kind of, have like blinkers on and think like, you go through that bear market and they think your stocks aren't going to get affected. They are. You go through a bear market like that, there's not much you could do. You're going to have stocks that are dragged down massively, and your portfolio will suffer, and mine suffered through that period of time. And the thing is that even though when you make it out to the other side, when you look at the combination of factors that we had during that time frame, you had interest rates go to the highest levels they've been for a long time and raised up the fastest they've ever been, inflationary pressures, the supply chain. God, the supply chain was messed up for a lot of companies. You had the boom of the CV situation and the move back to the high street situation, you had GDP growth, the lowest it's been for a long time. You had a war in Europe for the first time since, I believe, World War II. So you had all these combination of factors coming in, oil sky high, and you think you're not going to have stocks that are affected. You think you're going to get through that period of time without any scars. You are. We are going to have stocks in that period of time that suffer. And that's what's happened. And personally, to me, that's happened. And I knew it was going to happen. We've just been blessed with such a good market for so many years that you are going to have stocks that fail. That is part of the game. And when you go through that period of time, your stocks are going to be pushed to the max, and there will be stocks that don't do well in that period of time and potentially don't make it out through that period of time. And that is what happened. But the thing is, portfolio, we've talked about this for many years on the YouTube channel and on the Patreon itself, is you just have to position yourself with a very good portfolio, and that pain will be limited. And if you have built up a portfolio, a strong portfolio, a diverse portfolio, you could get through that pain of that situation and not take too much of a beating. You're still going to have a few scars, but you get through without that much of a beating. And I think that was the big wake-up call for a lot of people. Now, personally for me, I used to probably go around 20 stocks. Now, in the last kind of few years, I've been building up more to that was the worst three I've ever done. It's hard writing sideways. I've gone more to 30 stocks. The reason why I built up to a higher range of stocks is because for me as an investor, in the last couple of years, I've gone a little bit more to the growth side. The reason why I've gone a little bit more to the growth side is because I back myself as an investor a bit more now. I've got a bit of confidence where I believe I am better at valuing companies and identifying better growth companies. Now, the problem is with growth companies, there is the risk, and as we've seen with the risk of a environment that we're being through, growth companies take an absolute battering. And that's why I went a little bit more diverse in the last few years, is because my portfolio went from about 20% growth companies to, I would say, 40% growth companies. I would say I doubled up the percentage of growth companies I put in the portfolio, and because of that, I needed to protect my capital a little bit more. I needed to have more investments and be more diverse on my portfolio. And because of that, I was able to come out of this awful market with, I would say, scars, but I'm not absolutely devastated. My wealth hasn't been devastated, and that was the key thing that I needed to do. So in a portfolio, for example, let's say 10%, there we go, switch pens, 10% of my portfolio, let's say that goes completely wrong. Let's say 10% of my portfolio, let's say I've got 30 stocks, so that would be 3 stocks. Let's say 3 stocks go wrong in my portfolio. Let's say they go bankrupt. Now, obviously, that 10% is a killer. That's not good. You don't want that to happen. But the thing is, it's only 10%. You have all of this portfolio to make up. You've got 27 stocks to make up for them 3 that went wrong. And in them 27 stocks, if you can hit a few stocks, 3 stocks that make up 100% return, you recover them stocks, as long as they were equal positions, you recover the mistakes that you have made. And that was the key thing of having a good portfolio going to the bear market. If you have one stock that goes on to be a 5-bagger, you easily make up them mistakes and more. You only need one really good performing stock to make up for that mistake. And that's what is really key. And even you could go to the point of, at 20%, let's say 20% of your portfolio goes wrong. That's obviously not great. 6 stocks out of 30 go wrong. Not great. But even at that point of view, if you get 6 stocks wrong, really wrong, your other 80% of the portfolio, same again, you only need, out of the remaining 24 stocks, 6 stocks to get 100%, and you make up that mistake. You only need 1 stock to make a 5-bagger and another stock to get 100% return. You've made up your mistakes, and then hopefully the other stocks that are not them stocks drag you up as well with maybe even smaller returns. I mean, if you talk about even one stock, and this is the big thing that people always forget. Let's say 20% of your stocks go kaput. Let's say 6 out of that 30 go bankrupt. You only need one of those remaining 24 stocks. if you are able to hold that long term and really pick a good performing stock, these stocks that go bankrupt, you lose 100% of your wealth. But that one stock, if that stock returns, let's say a 10 bagger, 1,000%, that one stock makes up plenty for all the mistakes you make and even more. And that's the great thing about long-term investing as well, is that the maximum you can lose is 100%, and the maximum you gain on the long side is unlimited. You can go 5 bagger, 10 bagger, 20 bagger, and that can easily help you perform absolutely amazing. And as an investor, that's the key that we're actually trying to look for. If you can get that one high returning stock that can easily make up for many mistakes and really help your returns. And as long as you've got a portfolio that is, well diverse, you could afford to make, you could afford to make 3 mistakes, maybe even 6 mistakes. And don't get me wrong, even me, I made a few where I'm looking at a few of my 30 stocks in my portfolio, and I look at a couple of them, TTCF for example, where I think that's not a good position, and obviously that's gone out of my portfolio. And I think even when I look at my portfolio now, there's 1 or 2 that I look at and go, I'm not sure on them. But the good thing that I've had as an investor is that even though I might personally have 3, 4, 5, up 6 companies that maybe go wrong in the next few years, as long as those 24 that are left make up for them mistakes, I'm going to do well as an investor. And that's what was really key as well. And you probably saw me as well through that period of time, making sure I've got that balance completely right. And that's also what helped me. Now moving on to the next one, which is I want to talk about 2 stocks, and maybe I was wrong to sell these stocks. And I actually got this from talking to someone the other day, and we were talking about seeing the stocks go open, how many sub-stocks that have skyrocketed, and then talking about these 2 stocks that I bought, and since I bought them and then I sold them, they've continued to go upwards. And I want to give you guys my thought process behind that, and if I made a good decision or a bad decision. So we'll take a look at these ones. So first of all, let's talk about this first one that I sold, Celsius. So Celsius I bought in the start of 2022 when it started having this dip around here. So I held this company for around about 1.5 years. My average was somewhere, I believe, in the high 60s to 70s. So obviously the stock would now for me be up over 100%. Now for me, I kept selling out a lot of my positions, and there was times where I was taking over 100% profit in the company. For me, I was trimming a little couple of times, every so often selling 10% of my shares, and then it got to this point here and I sold my shares. Now the reasons behind me selling these shares is because I thought the company was a bit richly valued, but I was also a bit worried that the company wasn't expanding into Europe quick enough, and also there wasn't any guidance on the company's future, and also quarter over quarter there was a sales decline. Now since then they have brought on other earnings. The earnings were pretty solid and Wall Street seemed to like it, and it has rallied up since that time frame and gone to new all-time highs. Now the valuation of itself is a little bit rich. You can see here, they're going to do 150 million in profit, compared to that to 11 billion market cap. So it is a bit of a rich valuation here. But you can see here that if people do want to take this to a crazy value, I could still hold some shares, and at the end of the day, if it was to return back down to these sort of levels, I could have bought some more, worst case scenario. But I did have a good position in Celsius, and as you can see, the growth was going to still be very rapid, and the profit growth was still going to be rapid. Now obviously I've told you my concerns that I had with this, and you can understand why at the time, if I'm unsure in the business, then I probably should sell the business. Now looking back, was this a mistake to sell Celsius? Probably, because the company was still going to grow and the share price has continued to go upwards, and I still had a good position. Now looking back, I can understand still the concerns that I had around the business, and the concerns around the Europe expansion still exist with the business. However, the difference is looking back on this position, and I don't know why I broke this trend, is that all the way through here, as I've had these concerns, I've just sold 5%, 10% of my position off every time. And when I look at this position here, I should have continued to hold this, especially if the company had a really good average, especially if the company continues to grow revenue and profitability. I should have been patient and go, I still have concerns, and it does make sense, like I've done previously, to sell 5-10% of my position off the table and take a little bit of profit, and that would have made sense rather than selling all of my stock out there. So when I look back on a position like this, as long as the company continued to perform, I should have probably held this stock at a really good average, and if I had the concerns, I should have done my old tactic of just trimming the position. And when I look back now, selling all the position did not completely, or was a bad move to make. However, at the end of the day, as I always say, us investors, what we're here to do, we're here to make money, and I did make a good amount of money off Celsius at the end of the day, so I cannot beat myself up too much on that. And from there, all I need to do now is say Celsius has done its job, it's made my money, the company is now dead to me. I put on a target price, I put the target price on what I'd be willing to pay for Celsius if it was to have a dip, and if it does come back to the right value, I buy it, because I don't know right now, would I want to buy at this value? Probably not. So that's probably a mistake that I made with Celsius, is that I should have been trimming rather than completely getting rid of the position. Now the next stock is Tesla. Now I'm going to say this because I know a few people do get quite emotional about Tesla, is that I am a Tesla fan. I've owned the stock 3 times. I've owned it and made very good money. Now the last time that I started buying the stock was when it was having this dip around this time frame. Now from here, the stock did have a rally up here, and I was sitting on profit on this stock. However, the difference between Celsius and Tesla is that for Celsius, I had a good year and a half to build a position up. With Tesla, I only had around about a month, so I didn't get as many shares as what I would like. So that was a big difference between these two stocks and my thinking process here, and what I'll tell you straight away at that point of view. Now, since the time frame since I bought and I sold the stock for a good profit, the stock has then gone and rallied up even more. So I could have been up over 70% if I held, rather than the 25% I think it was that I sold Tesla for. So was I wrong to sell the stock compared to Celsius with this one? Well, the difference is that for me, I only had a small position in this one. So you've got to imagine I have to do all the work and the keeping up with Tesla for a smaller position. I can't, like Celsius, I said that I probably should have trimmed it because I had a large position. I could afford to do that. Tesla, it wouldn't have made sense to trim the position. And the reason why, it was already a small position, and if I was to trim it, it would only be smaller, and it would once again mean even more up work for even a smaller position. So that was what didn't really make sense with that one. The difference as well between Tesla and Celsius is Celsius is at a rich valuation, and Tesla is also at a rich valuation, in my opinion. 75 times earnings is quite a rich valuation. And the difference between Celsius and Tesla is Celsius is really still ramping up the profitability, as you can see. Apart from this dip here, which is to do with a Pepsi deal, the revenue is still growing up rapidly, and the profit is still jumping up really good amounts as well. The difference with Tesla is when I look at the company, the revenue is growing, as you can see here, but it is growing at slower rates than it has done previously, but the profit is declining, which is an issue. Now, I'm looking at this company here thinking the company is rallying up on the share price, but yet the company financially isn't performing that well. And when I look at Tesla, if Tesla has to do the valuation that I think is worth holding it has got to grow profitability at really good rates. Celsius, you can see here, the revenue is going to be growing at good rates, the profitability is going to be growing at good rates, and that is what I want to see. Whereas Tesla, the problem is if you're trading at something like 75 times earnings and you're only growing 20% a year and your profit is actually declining, that is an issue. And there's also got to be a point of view where I've got to have a system where eventually stocks get to a point where they're so overvalued, I have to take the profit off the table. And if I stick to the system of valuing stocks, or how I value stocks, then I will get more right than what I get wrong. If Tesla share price does want to go a little bit more crazy as it's going up a little bit now, that can happen in times. I can actually sell stocks and that stock can carry on going upwards. And I can't help that. It happens in the stock market. But as long as I have a system, I will get probably more right than what I get wrong. And that's the key thing. And my system on what I was doing on valuation was looking at Tesla going, I can't justify this, I'm going to have to sell. And what the justification for Tesla would be, for example, is at 75 times earnings. Because this is now a company that is focused rapidly on profitability, I think it's 75 times earnings. You have to get to a point of view where you have to talk about Tesla from these levels of 12 billion. You have to talk about Tesla probably getting to, I would say, double or triple the profit. You're talking, I would say, somewhere between 24 billion in profit to probably the likes of 30 billion in profit to justify that valuation. Now, the issue is when you look at the likes of Tesla, that profitability is dropping. Now, they are forecast for it to jump up in 2024, but that is where the unknown comes. And I have to look at that and going, do I think Tesla can realistically get from 10 billion in profitability in 1 year to 16 billion in profit the next year? That's a crazy jump. And obviously, in the environment that we're in, I don't know if they could do that. So I have to weigh that against my valuation model and go, I don't think Tesla would get there, and it doesn't justify me owning it. Now, if I was in the position of Tesla where I actually had a built-up position, I would probably go to the point of view where I'd go, okay, I'm just going to trim it now. So that would be the difference I would have if I actually had a built-up position in Tesla. I'd go, I'm going to trim it now, just like how I said with Celsius. But when I look at Tesla, was it a mistake to sell it even though it's gone higher since I did sell? I would say no. I would still do the same thing once again, because the valuation to me, my model, the model that I have to follow, I have got to have a process, and my process says that this is overvalued. And if I follow the process, I can't always predict where the stock's going to go in short term. If it's going to go to crazy valuations, it's going to go to crazy valuations. But as long as I have a process, that will help me get more right than wrong, and I will sell my profits at the right time. My valuation was telling me that this is overvalued, and I would stand by that I made the right decision to sell it. However, like I said, given if I had the larger position, I would obviously be trimming this rather than selling the whole position. So with Tesla, even though the stock has gone higher, would I say I was wrong to sell? I would say no, because my process tells me that this was the right time to sell. With Celsius, would I say I was wrong to sell? I would say yes, because I did sell, and I would still back selling and trimming the position now. But the difference is that I should have trimmed slightly on the stock rather than selling all the position. And as long as I've got a good average on a good company and they're going to increase profit and revenue, I should have just carried on riding that up, and that's a mistake that I made with that one. So anyway, hope you enjoyed the video anyway, guys. A lot of information there, a lot of things that help me get through the bear market and things that I should have done better. Hope you enjoy it anyway, bit of a longer one. Have a great weekend. And also on the Patreon, I'll be dropping 2 exclusive videos on there for you guys on the weekend, so keep an eye out for that. And if you want some exclusive content over the weekend, get in the Patreon. It's only £5 a month. It's cheaper than most patrons out there, and also you get 2 exclusive videos on some of those patrons. You don't even get any exclusive videos. You just get a Discord. You get a Discord on this one, but you get the 2 exclusive videos a week as well. And it's only the price of a pint, isn't it? It's not bad at all. So hope you enjoy it. Catch you in a bit.